In this lecture, we'll be looking at integrated reporting. This is in chapter 17 of your textbook. Entities have found that with traditional reporting, there is no scope to include information relating to an entity's overall business model, how it is achieving its aims over time, and how stakeholders are affected by the focus on the creation of wealth. So because of this, the International Integrated Reporting Framework has been developed. This framework was developed by the International Integrated Reporting Council, and it seeks to address the issue by providing guidance on the preparation of an integrated report. Traditional financial reporting has had a backward-looking focus. However, this only gives a certain part of the story, and stakeholders are interested in three discrete elements of the value of a business. So stakeholders will be interested in the current shape and performance of the business. Stakeholders will also be interested in the likely effect of management's plans, external issues, and opportunities that the business has. Stakeholders will also be interested in the long-term value of a business. So integrated reporting actually combines financial and non-financial information with a forward-looking perspective. And with this forward-looking perspective, the aim is to help readers and stakeholders understand all three components of business value. So what is integrated reporting? So a definition from the International Integrated Reporting Council says that integrated reporting is a process founded on integrated thinking that results in a periodic integrated report by an organization about value creation over time and related communications regarding aspects of value creation. So basically, integrated reporting combines different aspects of reporting. It combines the financial, management commentary, governance and remuneration, and sustainability reporting. It combines these together to explain an organization's ability to create and sustain value in the future. So integrated reporting will also highlight the need of the long-term business sustainability. So business sustainability is basically ensuring that a company manages its economic, social, and environmental risks. Also, that a company manages its obligations and opportunities to ensure that it will continue operating and creating value in the long term. So from this, you can see that integrated reporting doesn't only focus on the profit or economic aspect, it is also concerned with the social aspect and the environmental aspect. So integrated reporting has also been defined as a process, not a product. So integrated reporting requires a deep understanding of the strategies being adopted by the company, the risks the company is facing, and also the opportunities the company is pursuing. It will also involve giving details of the company's operations, as well as the organization's impact on the environment and wider society. So the aim of integrated reporting is to help simplify annual reports, and it hopes to do this by highlighting critical information and removing excessive detail that is not necessary. So if we look at this slide, we are discussing integrated thinking here. So what is integrated thinking? This is the active consideration by an organization of the relationships between its various operating and functional units and the capitals that the organization uses or affects. So it is hoped that if there is integrated thinking, this will enable a company to have integrated decision making and will result in actions that consider the creation of value over the short, medium, and long term. So integrated thinking actually requires the different disciplines within the business to work together. When these different disciplines work together, it will allow for integrated thinking, and this is key for successful integrated reporting. So integrated reporting will more likely be successful when it includes the following functions. So it will have finance, performance reporting, sustainability, governance and regulatory, risk management and strategy, operations management, corporate communications and investor relations, human resources, stakeholder engagement, and information technology. The aim of integrated thinking is to have one view of the business and an agreement on a single set of material issues to address with one combined strategy. So it's basically all these different functions coming together to agree on what the strategy of the company will be. So you will have the finance department coming together, you will have the human resources department and people from the information technology department. You will also need to consider stakeholder engagement, risk management and strategy, and various other functions to ensure that integrated thinking is successful. So in financial management, we usually say that the objective of any company is to maximize shareholder wealth. And you can see that there's a focus there on wealth, or the wealth that is created to shareholders. But this is different to value creation. If we look at the slide on value creation and we ask ourselves, what is value creation? So value creation is the process that will result in increases, decreases, or transformations of the capitals caused by the organization's business activities and outputs. So as you can see from this definition of value creation, it goes beyond just providing a financial return for shareholders. So value creation is also interested in the other aspects besides making a profit or contributing wealth for shareholders. So value is not just created within an organization by itself. It is also influenced by the external environment in which the organization operates. It can also be created through relationships with the various stakeholders, and it is dependent on the various resources that the company has. So the resources and relationships used by a company are generally referred to as capitals by the International Integrated Reporting Council. So the organization depends on these capitals for their success, and they are categorized by the IIRC into different categories. So we can have financial capitals, we can have manufactured capitals, human capitals, social capitals, relationship capitals, and natural capitals. We can also have manufactured capitals. We'll have a look at these capitals in detail later in the chapter. So the aim of integrated thinking is to be able to produce an integrated report. So what is an integrated report? This is basically a communication that is concise and specific on how an organization's strategy, governance, performance, and prospects in the context of its external environment will lead to the creation of value in the short, medium, and long term. So the purpose of an integrated report is to explain to shareholders or providers of capital how an organization will create value over time. So the integrated report will give details about the external environment in which the organization operates. It will also give detail about the resources and relationships which it uses and how it interacts with both, with the aim of creating value. So what is the aim of an integrated report? The aim of an integrated report is to explain to the providers of financial capital how an organization creates value over time. Remember, the providers of financial capital could be shareholders, and they could also be banks and financial institutions that have provided loans. So the integrated report will also aim to provide information about the external environment in which the organization operates. It will also provide information about the resources and relationships which it uses and how it interacts with both to create value. The International Integrated Reporting Council has not made it compulsory for companies to prepare an integrated report. So it is up to each individual country to decide whether integrated reporting is mandatory or voluntary. So if we think about South Africa and JSE listed companies, it is mandatory for listed companies in South Africa to prepare an integrated report. And this is also true in Brazil. It is also mandatory for listed companies to prepare an integrated report there. Whereas there are other countries like the UK, Australia, Japan, and the USA where integrated reporting is voluntary. However, it must be said that in these countries where integrated reporting is voluntary, there has been a growing movement towards preparing an integrated report. The IIRC has prepared the International Integrated Reporting Framework to guide those organizations that prepare an integrated report. The International IR Framework doesn't specify how regularly an integrated report needs to be produced. However, according to the IIRC's website, they are usually prepared annually. If we have a look at the presentation of the integrated report, it can either be a separate standalone document on its own, or it could be included as a distinguishable prominent part of another report or communication. So what this means is that it may be included at the front of a report containing the company's financial statements, or it could be separate. So if you think about financial statements, most publicly listed companies need to have their financial statements audited. And the international standards on auditing provide this guidance on how to audit financial statements. However, there is currently no mandatory requirement for independent assurance to be given on an integrated report. So companies may decide for themselves if their integrated report needs to be subject to an assurance engagement, and also to what extent the integrated report complies with the International Integrated Reporting Framework. While various standards exist for non-audit engagements, there is currently no specific assurance standard for integrated reporting. If you think about it, if an assurance engagement is performed on the integrated report, it is likely to improve the report's credibility from the perspective of its stakeholders. However, there are certain challenges in auditing or providing assurance engagements on integrated reports. So such challenges include the difficulty of developing suitable criteria for assuring the integrated report. What are they going to measure what is said against? There's also a limited ranges of skills of the traditional audit team. They may not have experience in providing assurance on these type of engagements on the integrated report. There are also high costs involved in providing even limited assurance on an integrated report, and there is also additional risk of auditor liability. So it has been said that only those parts of the report that include factual disclosures can be subject to an assurance engagement, and the information that is abstract, interpretive, or based on prediction, it is too subjective to have an assurance engagement. So we have mentioned the International Integrated Reporting Council, or the IIRC, before. What is the composition of this council? It is made up of various parties. It includes regulators, investors, companies, standard setters, accounting professionals, and it can also include non-government organizations, in other words, NGOs. And these people are drawn from all over the world. So the mission of the International Integrated Reporting Council is to establish integrated reporting and thinking within mainstream business practice as the norm in the public and private sectors. The vision of the IIRC is to align capital allocation and corporate behavior to wider goals of financial stability and sustainable development through the cycle of integrated reporting and thinking. The IIRC believes that the cycle of integrated thinking and reporting results in efficient and productive capital allocation and will ultimately drive financial stability and sustainability. So let's have a look at the role of the IIRC. So the role of the IIRC has developed over time. Its original aim was to develop an internationally accepted framework for integrated reporting. The IIRC issued the International Integrated Reporting Framework in 2013. Thereafter, a phase of breakthrough followed. So the purpose of this phase was to achieve a meaningful shift towards early adoption of the international IR framework. So now the IIRC is in the momentum phase of its strategy. The objective for this phase is to change the corporate reporting system so that integrated reporting becomes the global norm. So far, 1,600 organizations in over 65 countries have used the principles of the integrated reporting to develop the way they think, act, and communicate about value creation. So if we have a look at this slide deals with the objective of the International Integrated Reporting Framework. So the purpose of the International Integrated Reporting Framework was to establish guiding principles and various content elements for the preparation of an integrated report. The framework is written primarily to be applied by companies operating in the private sector or for-profit companies of any size, but it can be applied or adopted to public sector and not-for-profit organizations. So the framework takes a principles-based approach and is based on three fundamental concepts. These fundamental concepts are value creation, the capitals, and the value creation process. So what is value creation? This is when there are increases, decreases, or transformations of an entity's capital caused by its business activities and outputs. So value may be created for the entity itself or for other external stakeholders. So if we have a look at the capitals are stocks of value that are increased, decreased, or transformed through the activities and outputs of the organization. The capitals comprise financial, manufactured, intellectual, human, social, relationship, and natural capitals. So the value creation process is the process when the entity uses its capitals as inputs and converts them to outputs. An entity's outputs include its products, services, byproducts, and its waste. So if we have a look at this slide, this is a slide showing the various capitals. And like we have said, the capitals refer to the resources and relationships of the organization. So all organizations rely on the various forms of capital, not just financial capital, for their success. So the framework defines 6 capitals as follows. So if we have a look at the first one being financial capital, this is the pool of funds that is available to an organization which it will use in the production of goods or in providing services. So it can be obtained through financing like debt from a bank or equity or raising equity by issuing shares. It can also be obtained through grants from the government or generated through operations or investments. If we have a look at the next capital, being manufactured capital, This refers to manufactured physical objects that are available to an organization to be used in producing goods or providing services. These include buildings, equipment, machinery, or various infrastructure. So here infrastructure refers to various roads, ports, bridges, and water treatment plants. It is often created by other organizations, but includes assets manufactured by the reporting organization. If you think about it, this capital is usually created by other organizations. We will buy equipment from another company that manufactures that equipment, and the building we have could have been built by another organization. But it could also be assets that are manufactured by the reporting organization. If we have a look at the next capital, being intellectual capital, this is organizational knowledge-based intangibles, and this includes such things like intellectual property, such as patents, copyright, software rights, and licenses that the company uses to manufacture a good or provide a service. It also includes things like knowledge, systems, procedures, and protocols. The next capital is human capital. So this refers to people's competencies, capabilities, and experience, and their motivations to innovate that are employed by the company. So this includes things like support for an organization's governance framework. It could also include support for management approach and ethical values that a company has. It also includes the ability to understand, develop, and implement an organization's strategy. If we have a look at the next capital refers to social and relationship capital. So this refers to the institutions and relationships within and between communities, groups of stakeholders, and other networks, and the ability to share information to enhance individual and collective well-being. So it refers to shared norms, so it includes shared norms and common values and behaviors. It will also include key stakeholder relationships and the trust and willingness to engage. It can also refer to intangibles associated with the brand and reputation that an organization has developed. For example, certain brands will be associated with quality and trust. It also includes an organization's social license to operate. The last capital in the framework is the natural capital. This refers to all renewable and non-renewable environmental resources and processes that it uses in providing goods or services. So it includes things like air, water, land, minerals, and forestry. It can also include biodiversity and ecosystem health. What you should notice, though, is that the capitals are interrelated. So if we think about expenditure on staff training, this results in an increase in human capital and a decrease in financial capital. That staff training will cost money, which will decrease financial capital. However, it will result in an increase in human capital. Also, anything the company buys, such as machinery, equipment, new software, this will result in a decrease in financial capital, but it will result in an increase in such things like manufactured capital, which the company can then use to produce goods or services. So the next slide here deals with the value creation process. So how does an entity create value? It creates value by using its capitals and interacting with its external environment. Obviously, this depends on its business model and strategy, the risks and opportunities it faces, and how it allocates its resources also comes into play. The external environment in which the company operates will also impact the value creation process. So the value creation process will involve a company's business model, which then draws on the various capitals as inputs and converts these capitals to outputs, such as products and services, but it also includes byproducts and waste. So these activities and outputs then lead to outcomes, which in turn affect the capitals. So this slide deals with the guiding principles. There are 7 guiding principles that the integrated reporting framework requires a company's reporting to display in order to be seen as meaningful. The first one we're going to look at is strategic focus and future orientation. This guiding principle will provide insight into strategy and plans for the future in the context of capitals and value creation. The next guiding principle is connectivity of information. So the information must show a holistic picture and be interrelated. It must also show the dependencies of factors that affect ability to create value. The next guiding principle is stakeholder relationships. This will provide insight into the nature, quality of relationships with key stakeholders and how the organization responds to their needs or interests. The next guiding principle is materiality. In integrated reporting, a matter is considered material if it could subjectively affect the organization's ability to create value in the short, medium, or long term. The next guiding principle is concisiveness. The information provided must be enough to ensure there is understanding, but it mustn't obscure important information with less relevant information. The next guiding principle is reliability and completeness. The integrated reporting framework must give a balanced view, including positive and negative material matters without material error. The last guiding principle is consistency and comparability. The information presented must be consistent over time and must allow comparisons to be made with other organizations. So in this slide, we look at content elements. So the content elements describe what an integrated report should include, but they do not have to be shown in the order listed. We also need to understand that the framework is principles-based. There is no prescribed format for an integrated report. The idea is to allow management to apply the integrated framework in the context of their specific organization. So the elements are not supposed to be a set sequence of isolated sections, as this would not reflect the fact that the content elements are fundamentally linked to each other. So the integrated report should present the content elements in such a way which shows how the content elements are linked to each other for the particular organization. So if we have a look at the content elements that are presented in the framework, you'll see that they are presented as questions. And these are questions that the integrated report should answer. It is not a checklist of specific disclosures to include, as this is too restrictive and does not take into account the differences that exist between organizations. So you'll see here that the elements do not have to appear as specific headings, but the integrated report should answer all of the questions in a way that makes the relationship between them apparent. So here you'll see the various content elements. So the integrated report should answer the question, what does the organization do and what are the circumstances under which it operates? And if these questions are answered, this would be giving information about the organizational overview and external environment. If we have a look at the governance, the integrated report should be able to answer the question, how does the organization's governance structure support its ability to create value in the short, medium, and long term? The integrated report should also answer the question, what is the organization's business model? If we have a look at the risks and opportunities, the integrated report should address the risks and opportunities faced by the company by answering the question, what are the specific risks and opportunities that affect the organization's ability to create value over the short, medium, and long term. It should also answer the question, how is the organization dealing with the various risks and opportunities experienced by the company? If we have a look at strategy and resource allocation, the integrated report should answer the question, where does the organization want to go in the future, and how does it intend to get there? Information on the company's performance will also need to be provided. The integrated report should answer the question, to what extent has an organization achieved its strategic objectives, and what are its outcomes in terms of effects on the capitals? What challenges and uncertainties is the organization likely to experience when it pursues its strategy? It should also answer the question, what are the potential implications for its business model and future performance? The integrated report should also give information on the basis of preparation and presentation. It needs to answer the question, how does the organization determine what matters to include in the integrated report, and how are such matters quantified or evaluated? On this slide here, we're going to discuss the disclosures about the various capitals. So remember earlier we looked at the categories of the capitals that were fundamental to integrated reporting. So even though the framework categorizes the capitals into financial, manufactured, intellectual, human, social, relationship, and natural, it is not mandatory for a company to use these categories, and a company may define its own categories. The framework just merely includes these categories to give guidance to make sure that organizations consider all the different types of capitals they use to create value. There are various principles that are relevant for the disclosures of the capital. So a company should determine the disclosures by the effects of the capitals on the company's ability to create value, instead of whether the capitals are actually owned by the company. So the company could actually use various capitals that it doesn't own, but it must still make disclosure of this. So the disclosure must also include factors that affect the availability, quality, and affordability of the capitals. The organization must also disclose its expectations of the organization's ability to produce flows from the capitals to meet the demand. For example, there could be non-renewable capitals that is limited and that the company may not have access to meet the necessary demand. It is not meaningful to quantify significant movements in capitals, rather make qualitative disclosures to explain changes in the availability, quality, or affordability of the capitals. So there are various complexities, interdependencies, and trade-offs that also need to be considered when we are looking at disclosures of the capitals. An exhaustive account of all the complex interdependencies between the capitals is actually not required. The interdependencies between the capitals that are considered when an organization determines its reporting boundary must be disclosed. The reporting boundary is the boundary within which matters are considered relevant for inclusion in the integrated report. We also need to consider trade-offs when looking at the disclosures about capitals. So we need to disclose the trade-offs between capitals or components of a capital. For example, a company could create employment through an activity that is harmful to the environment. It also needs to disclose trade-offs that happen over time. For example, choosing an action when an alternative would result in a greater increase in capital at a later date. It also needs to consider trade-offs between capitals owned and not owned by the organization. What you generally need to understand is that not all capitals are of equal importance to every company. Some interactions between capitals may be very minor, so that it is not necessary to disclose these in the integrated report. So there are various benefits and limitations of the International Integrated Reporting Framework that we need to consider. In this slide, we'll have a look at the benefits. So one of the benefits of implementing the International Integrated Reporting Framework is that it connects departments. So integrated thinking is part of the definition. So integrated thinking underpins the framework's principles. So integrated thinking should result if the principles of the framework are applied. And the benefit of successful integrated thinking is that it encourages departments within a business to work together rather than as standalone units. Another benefit is that it improves internal processes, which can lead to better understanding of the business. So if there are changes to systems and procedures that are driven by the guidance in the framework, they are likely to provide greater visibility across business activities and will help to improve the understanding of how organizations create value. Another benefit is that there is increased focus and awareness by senior management on the long-term sustainability of the business. One of the framework's aims is for an integrated report to provide insight into how an organization creates value in the short, medium, and long term. So it actually should encourage management to focus on the financial stability and long-term prospects of the organization. Another benefit is that there is better articulation of the strategy and business model. Two of the content elements dealt with the business model and strategy of the business. If these questions are answered, then it will actually enable a better articulation of the strategy and business model. So one of the elements asked, what is the organization's business model? So if that is answered in the integrated report, it will lead to a better articulation of the strategy and business model. So the next question, dealing with strategy and resource allocation, was where does the organization want to go and how does it intend to get there? So when answering these questions and including them in the integrated report, it actually provides management with an opportunity to clearly articulate the organization's strategy and business model. Another benefit is improved performance. Remember when we looked at the content elements of the integrated report in the framework, one of them was looking at the outlook, which requires the company to consider the challenges and uncertainties that it is likely to encounter and the potential implications for the business model and future performance. This is a forward-looking approach and will allow management to identify ways of improving its performance in future years. Another benefit deals with improved relationships with stakeholders. One of the guiding principles of the framework is stakeholder relationships. So in the integrated report, it is necessary to provide insight into the nature and quality of the organization's relationships with its key stakeholders. If this is done, this will encourage management to achieve the best possible relationship with its stakeholders, which in turn should actually benefit the organization through subsequent decisions by stakeholders. Another benefit is consistency in approach between companies. So if we look at the fundamental concepts, guiding principles, and content elements of an integrated report outlined in the framework, it should result in a consistent approach between companies, which will assist potential investors when deciding which entity to invest in. Another benefit is that there is a principles-based approach which allows the report to be tailored to specific entities. So the framework adopts a principles-based approach rather than a rules-based approach. So this recognizes that there is a wide variety of individual circumstances of each organization, and it allows flexibility for entities to tailor the integrated report to their specific industry and company. Another benefit is that it provides guidance for preparers of an integrated report. Without the framework, management would not know how to approach the preparation of an integrated report. The framework therefore provides clarity and should improve the quality of information available to providers of capital. The last benefit we're going to look at is that there's quality assurance for those users of an integrated report when it is prepared under the framework. So when an integrated report is prepared using the guidance in the framework, it will have much greater credibility for users than a report that is prepared without such guidance. So now that we have had a look at the benefits of the integrated reporting framework, let's have a look at the limitations. So one of the limitations we need to look at is that there's a lot of time and cost that is needed when preparing an integrated report. So when preparing an integrated report in accordance with the framework, it is going to take a considerable amount of time and effort. It will also require an implementation of new systems and procedures at a cost to the business. Another limitation is that management may be reluctant to disclose forward-looking information. So the framework requires an integrated report to disclose forward-looking information. Management may be reluctant to do this in case investors place undue reliance on it, or it could give away sensitive information to its competitors. Another limitation is that it can be challenging to articulate what an entity's capitals are and to determine appropriate measures of these capitals. So although the framework identifies 6 possible capitals, not all of these will be appropriate to all companies. Also, there could be capitals not mentioned in the framework that may be relevant for a particular company. Therefore, it may be challenging for management to identify what the organization's capitals are. The framework also requires disclosure of significant movements in capital. However, it does not give guidance on how to measure these movements. So another limitation is that it may be challenging to determine what is material. So remember when we looked at the guiding principles, one of them was materiality. So matters will be considered to be material in an integrated report if they would substantially affect the organization's ability to create value over the short, medium, and long term. There is a significant amount of judgment that will be required by management to determine what is material. The materiality used in an integrated report is likely to be different to the materiality in the context of financial statements, and this may confuse users of an integrated report. Another limitation is that it needs to be adapted for not-for-profit companies and public sector organizations. So the framework is written in the context to be applied to private companies and for-profit companies. Therefore, if it is going to be used for public sector organizations or not-for-profit companies, it needs to be adapted by those companies. Another limitation is that it gives non-mandatory guidance. So there is a risk that there could be a low uptake of the companies adopting integrated reporting. So the framework provides guidance for companies that want to prepare an integrated report. However, it does not make integrated reporting mandatory. It is up to the individual countries to determine whether the integrated reporting should be mandatory. Very few countries have introduced mandatory reporting. Even though the number of countries choosing to adopt integrated reporting is increasing, it has not yet become the global norm. So if there was a higher adoption rate, would be achieved if integrated reporting became compulsory for listed companies around the world. The last limitation we're going to look at is that there is a lack of prescribed format which reduces comparability between companies. So even though the framework contains content elements, these are not required to appear as separate headings and sections in an integrated report. So the organization are simply required to address the questions related to these content elements in the integrated report. Therefore, there is no single prescribed format for an integrated report. The framework permits an integrated report to be presented as a standalone document or included as part of another report. As a result of this, there is likely to be reduced comparability between the integrated reports of different companies, which will result in a reduction of their usefulness to stakeholders. So this is the end of the lecture on integrated reporting. Thank you for watching.